Welcome back. I'm Jeremy Safran. It's a critical week for the Federal Reserve, and the pressure is mounting. Now, Chair Jerome Powell returned to Capitol Hill today as confidence in the Fed's stance continues to erode. Now, bond markets are now fully pricing in 2 rate cuts by December, according to Bloomberg, even as Powell reiterated that inflation could pick up again in the second half. Now, at the same time, the U.S. economy is sending increasingly mixed signals. Student loan delinquencies are spiking. Home prices are falling during the spring season, which is quite rare. And then we've got these continuing jobless claims that are trending higher. According to TransUnion, over 6 million borrowers are now about 90 days behind on their federal student loans, and that number is expected to climb. Meanwhile, President Trump has brokered a fragile ceasefire between Israel and Iran, possibly averting a broader Middle East conflict, but adding to the policy uncertainty facing the Fed. Now, in this morning's testimony, Powell acknowledged that rates are now, quote, modestly restrictive, and said that the path forward is, quote, highly uncertain. He avoided commenting on Trump's tariffs and tax plan directly, but admitted that inflation pressures could resurface as early as June and July CPI reports. And in a key exchange, Powell was pressed on whether a rate cut could come as soon as July, especially after Fed Governors Bowman and Waller both said that they're open to that possibility if inflation stays muted. Let's play that clip now.
Do you believe that we are in a position where we may be able to cut rates in July?
So I would say this. I think if it turns out that inflation pressures do remain contained, then we will get to a place where we cut rates sooner rather than later. But I wouldn't want to point to a particular meeting. I don't think we need to be in any rush because the economy is still strong. The labor market is strong. If we were to see the labor market, meaningfully weaken in a way that was concerning, that would matter for that decision. But if we see inflation, continuing not to move up, we hadn't expected inflation to move up much. We do expect it to move in the summer, and if we see it not happening, we'll learn from that.
All right, the learner promise. So is the Fed playing it safe or falling further behind the curve? Let's find out. And welcome back one of our regulars, Danielle DiMartino Booth, CEO and Chief Strategist of QI Research, former advisor to the Dallas Fed. As always, we appreciate you making the time for us.
It's great to be here today. Thank you for having me.
Okay, I'm sure you were glued to the TV like the market was, not maybe looking as much at the conflict in the Middle East, but more about Powell's testimony. He said that rates are mostly restrictive, that it's a shift from his earlier language, as you can remember. I mean, Governors Bowman and Waller both signaled that the cuts could come as soon as July if the data supports it. If Powell still isn't ready to commit here, Danielle, I mean, do you see this as caution, or is it the sign that the Fed is again ignoring what the data has already been showing?
So I think it is the latter, to the extent that Chair Powell continues really to disregard and dismiss a lot of the data that we've seen. Just this morning, we had out fresh information on home prices declining for a second month in a row, according to S&P Case-Shiller. That's in peak spring selling season, March and April. We know that the month of May has been weak for home sales. So we know that there's going to be a third month of declining home prices, and that's what economists call a trend. So I think that any kind of impulse that you see from the largest input to the CPI is going to supersede what companies are telling us, and that's that they really haven't been able to pass through higher input costs because of tariffs through to their end buyers.
Yeah. And then there's the labor market. I mean, according to the Bureau of Labor Statistics, these benchmark revisions showed nearly 800,000 fewer jobs created through March than initially reported. I mean, you and I have been talking about this for over almost, it feels like a couple of years. These revisions keep coming. I mean, continuing claims are up more than 25% year over year. Is the Fed underestimating the deterioration in the labor market here, Danielle?
I think the Fed is, and there's an irony because right now funding is at risk for the Bureau of Labor Statistics. And Chair Powell was asked about that when he was up on the Hill today. And he said, well, yes, there has been a degradation in the quality of the data. But let me tell you, as you mentioned, it's been years now. I mean, so this is a systematic downward revision of payrolls, unlike anything we've ever seen in U.S. history, and certainly of a greater magnitude. So at this time, the onus really is on Fed policymakers to be paying heed to other types of indicators that show the labor market is anything but solid.
Yeah, let's get into, I was crawling your X page. It's always, great insight, by the way. If somebody's not following it, they should be. And, you've been flagging these student loan stress as kind of a major underappreciated macro threat. You said that according to TransUnion, more than 6 million federal borrowers are now 90 days delinquent. That's up from 1.2 million in early May. You also said another 2 million could default in July. If that number happens, what's the likely impact on consumer demand? But GDP in the second half, that's a big number.
Right. And to your point, when we're talking about student loan borrowers defaulting, I think the critical distinction here is that we're not talking about the lowest income earners. We're talking about individuals who make higher salaries and therefore contribute more to the U.S. consumption that is 70% of GDP. If it's this particular higher earning demographic that's in the crosshairs, we have to pay attention to this because, as you say, we're going to start to see the fallout in the second half of 2025. And into 2026, we have to remember that we're not talking about student loan borrowers in isolation, but that they have other kinds of household debt, such as mortgages, auto loans, credit card debt.
Yeah, to your point, the New York Fed's Q1 2025 household debt and credit report showed that also credit card and auto delinquencies are rising sharply. Small business defaults just hit their highest level since 2020, according to Equifax. Again, we've discussed this, but how far are we into this broader credit crunch at this point?
Well, when you start to see headlines about a company that's the size of Wolfspeed, we're talking about north of $4.5 billion of debt preparing to file here in the next few days. You saw Career Builder, Monster file Chapter 11. Clearly, for the have-nots in terms of their access to the cheapest borrowing rates and small businesses and U.S. households, monetary policy is prohibitively tight. I get a lot of criticism because the assumption is, gee, do you just want to see money printer go burr and you want for speculation to get reignited? And my answer is, ask anybody who's trying to run a small business, ask anybody who's paying a 30% rate on their credit cards to borrow. They'll tell you Fed policy is too tight.
Yeah, absolutely. And I think, people are starting to acknowledge it, at least. I heard Jerome this morning start to talk about how he knows that this is happening, and that kind of is his claim. But yet here we are in the same kind of pattern, it feels like.
Right. And it's one thing to say that and it's another to follow up with actions. And I think that clearly what we're seeing in the last few days is that there is a growing division on the Federal Open Market Committee. There are individuals who are beginning to lean more on that employment mandate. We just had out fresh data this morning from the Conference Board that shows that expectations are continuing to fall. They're back where they were when the U.S. economy was entering the Great Recession, and individual households' views of the job market have been declining for 6 months in a row now. People are telling Chair Powell what he needs to hear if his listening ears are on, which is what I used to say when I had toddlers running the house. Are your listening ears on? I would ask the same thing of Chair Powell. Are you listening?
Yeah, let's go back to housing and shelter inflation, because you brought it up there, for a quick second, because that April data showed something quite rare. Declining home prices during the spring season, kind of unheard of. And according to the FHFA, prices fell about 0.4% month over month. The S&P CoreLogic reported a 0.31% drop. If this trend holds, do you expect the shelter component of inflation, something that the Fed has always leaned heavily on, to finally show sustained weakness?
I do. And to your point, and the word finally is critical here because it takes a very long time for home price increases and rental increases to make their way into inflation. And it also takes them a long time to make their way out. There's a big lag effect to it. But the fact is, home price appreciation has been more than cut in half just here in the last year or so. That is going to show up in inflation metrics, and it is going to overwhelm, because it's the highest weight in inflation, any kind of a tariff upward pressure to prices because of the tariffs, which again, we have yet to see.
Mm-hmm. Yeah, and according to Freddie Mac, to your point, the average 30-year mortgage rate is still at 6.8%. Is this home price weakness more about affordability constraints, or is it these deeper signals that we're talking about the economy?
Well, I think it's a combination of different factors that are feeding into this. It's much more difficult to get financing, and a lot of the individuals who bought homes as investments to rent them out as Airbnbs and VRBOs at the beginning of the pandemic, they're finding that they're not getting a sufficient number of people to come in and rent for a long weekend or for a week. That's just one element. Then you add demographics in with the aging out of the baby boomers. Many of them plan to stay in their homes. And then there's the death, divorce, and taxes, and those types of factors that are making people begin to start to sell their homes. And we're hearing that nationwide that inventory is much higher than it was throughout most of the large metros in the United States. At some point, the law of supply and demand kicks in, but there's a lot of things right now that are putting pressure on the housing market that are absolutely undeniable if you follow the data closely.
Fed officials, and you heard it this morning, you heard it in the intro, even him kind of talking about Waller and Bowman now publicly considering these rate cuts in July. Powell seems pretty constrained, by politics, by optics, or by inflation fears. And according to the Atlanta Fed GDP Now model, Q2, obviously growth is tracking under 1.5%. Is this deja vu from 2022, waiting too long and being forced to catch up?
I think that's the real risk here. I follow S&P Global's Ben Herzon because he basically invented the GDP model that most people have then imitated as the years have gone by. He's at 0.9% for the second quarter and at negative 0.1% for the first quarter, which is, of course, very backward looking. My goodness, we're almost all the way through the second quarter. But the point is, he's within a whisper of the second quarter number itself turning negative before we even have June data in hand. It is clear, even through the backward-looking prism of GDP, that the U.S. economy is slowing.
I got to ask you about the oil market and obviously geopolitics right now, because according to Bloomberg, Brent crude has fallen just below that $70, $68.50, I think, a barrel after President Trump's ceasefire deal between Israel and Iran took immediate effect. Does this help ease short-term inflation fears? If oil prices remain subdued, does the Fed have more room to move, or do we rely too much on this data? It almost feels like he said today, when we look at oil prices, we won't feel them for a year anyway.
Well, that may be true, but, according to JP Morgan Chase and their real-time tracking of debit and credit card spending at gasoline stations is down 11% year over year. That's provided households with a tremendous tailwind to their ability to spend on other things, groceries, discretionary travel, you name it. And I would say that any further downside that bleeds through to prices at the pump is going to be very beneficial to U.S. households, but for heaven's sake, it certainly won't take a year to show up in prices. I think the best thing that can be said of the drama that occurred over the weekend is that gas prices are lower than they were a week ago. That's fabulous.
Yeah, absolutely. And then we got the wild card tariffs, and we know he didn't really want to talk about it. He wasn't addressing it that publicly. Trump's policy is already kind of raising import costs in key sectors. According to Oxford Economics, the full tariff package could add 35 to 50 basis points to core inflation by early 26. If we get one or two soft CPI prints in June or July, then a tariff-driven spike later in Q3, what's the risk that the Fed is stuck in policy limbo?
So I think that there's kind of a presumption of pricing power that's built into a lot of these inflation forecasts that simply has not been manifest. We have continuing jobless claimants in the United States pushing up against that 2 million ceiling. We know that there are record numbers of multiple job holders, that aggregate income is declining. So again, I think operating under the presumption that companies are going to be able to pass through higher costs is a dangerous one for economists to take. I think the graver risk right now is that of margin squeeze. And indeed, that's what we're hearing from countless American companies.
Yeah, it's funny. Despite Powell's tone today, markets seem to be calling the Fed's bluff. The S&P really green on the day. According to Bloomberg, swaps markets are now pricing in that 55 basis points of cuts by December. That's two cuts with a 25% chance of a third. How do you interpret that gap between what Powell is saying and what markets are betting, kind of what you were just going on there about?
Well, it's the headlines that we see every day. It's the number of companies that are laying off individuals. Those headlines don't seem to stop. It's the number of companies that are going bankrupt. Obviously, in this kind of an environment, we don't have a lot of job creation. And in fact, we're going the other way. I think markets are paying attention to the data that they're seeing on the ground and the constancy of the headlines rather than, paying heed to Bureau of Labor Statistics headline payroll figures that we all know are going to be revised away.
At the same time, as these risk assets seem to be surging, credit spreads remain historically tight. Is this liquidity-driven disconnect, or are the markets kind of betting that the Fed will ultimately backstop everything and jump in?
Well, there's certainly a disconnect. And I think that because we are seeing the actual default rate go up in the credit markets, that markets may be very much getting in front of themselves. You can only bet so much on the Fed riding to the rescue if you're not contemplating going back to zero interest rate policy, but rather whether or not we're going to see 25 basis points of rate cuts come July. They're day and night in terms of the type of stimulus that they would provide to the markets. And 25 basis points here and there, that's not going to get us to where the credit markets are pricing in the economy right now. I think spreads right now in the credit market are much, much, much too tight.
Yeah, let's step back for a second. I mean, you warned that we're already in that recession, but also said recognizing cracks early allows investors to position ahead of the crowd. If the Fed does pivot, housing stabilizes, and say energy prices stay in check, what's your best case scenario for the second half of this year, 2025?
I think stabilization is about as much as we could hope for, and that would assume that there would be downward momentum in terms of companies cutting costs. And that's not what we're seeing come out in the survey data when most companies right now are saying we're going to cut costs, whether you're talking about the Richmond Fed, the Philadelphia Fed, the New York Fed, the ones that we've gotten out so far for the month of July. We've seen an across the board weakness in terms of their employment indexes within them. Until I see these begin to turn, then and then in turn become leading indicators of green shoots over the horizon. Again, I think the best that we can hope for in the second half is a stabilization right now in economic output, with the risk being to the downside.
And what's that, what would you need to see specific indicators in this next little short term before the end of the year to shift from that cautious to kind of constructive on that side?
Again, I would have to see companies going out and saying, we have every intention of expanding our headcount. We're going to be hiring people. That's a sign that income is going to be increasing. And again, the U.S. economy is 70% consumption. If we hear that income is going to be rising, that's obviously a very hopeful sign for things to improve in the future.
Yeah, what a wild time. I mean, how do you keep up in this? It's hard enough as a journalist. I can't imagine putting out these pieces of paper every day like you do with the Daily Feather Note, by the way. If you don't subscribe to it, you should. But just, is it replaying different years for you in your experience, or is this in its, field of its own?
No, look, history always rhymes, even though it never repeats exactly. And when you wake up and you say, hey, the expectations component of the conference board is at the lowest that it was at, it matches, parallels with what we saw in early 2008. That tells you something. And it's always good to look back historically to find benchmarks, even though the economy is dynamic and changes every day. And at QI Research, what we do is we're always trying to put onto our radar screen new and different and innovative ways to track the economy more in real time, so that we're doing what I did to a much lesser extent a decade ago when I left the Fed, and that's relying on backward-looking indicators. As an economist, you always want to look out the front window. I tell my teenage kids, please don't drive through the rearview mirror, and that's exactly what economists need to do as well. We need to look forward.
Yeah, congratulations on celebrating. I know it's an anniversary over at QI too, and you guys have a little bit of an offer. Indeed. Feel free to tell the audience, because I do think it's important to see this clear data that you're talking about. It's always sharp and it's always clear.
It is, and that's what we go for every single trading day of the year. We're running a 10-year anniversary promotion. Please come to QI Research. Come see me at dmartinobooth.substack.com. Our reading audience is growing, and that's fabulous because we continue to press forward with the research revolution. So please come become part of the QI community. Love to have you.
Even the mainstream's starting to wake up to it. Danielle DiMartino Booth from QI Research joining us from Texas today. Thanks for this. Appreciate your time as always. Happy summer.
Happy summer to you.
Thanks, Danielle. And that's it for this edition of Kitco News. For more interviews, market coverage, and of course, real-time updates, go to kitco.com and subscribe to our YouTube channel. I'm Jeremy Safran. Thanks for watching.